Let us begin the show by focusing on four big macro calls today from well-known firms, all kind of saying the same thing. Are you ready, folks? All right, let's walk you through it. Number one, Goldman Sachs, the market unlikely to make new lows. Morgan Stanley, pullbacks should be bought. JP Morgan Chase, we're going to hit all-time highs in the market next year. And Piper Sandler being more direct, the bear market has concluded. There you go. All right, let's join in. Guy Adami, you heard that. You got four calls, all kind of saying the same thing. It's not taken away from Main Street and the human toll. We understand. We are focused on the markets. Do you agree with those pretty optimistic views?
No, but I hope they're right. But the short answer is I just don't see how we get there. I thought the market, when we made an all-time high of 3,400, 3,393, if you were assuming $160 worth of earnings, the market was trading at 21 times. I mean, we're not going to get anywhere close to 160. I think Scott Minerd has said you could see 100. I mean, even if you say 130 is a 20% discount, and we're still trading at 21 times. So the market was expensive at all-time highs. I think it's expensive now. We've had a great run off the bottom. It got to the levels where a lot of us thought we would get. Will we make another new low? I have no idea, but I don't see this thing just continuing to ratchet higher in this current environment, so no.
Yeah, Tim Seymour, I guess there's another way to look at it, which is, I know we've had a little bit of a run here on the tech-heavy NASDAQ, but I suppose if you throw $6 to $10 trillion at a problem like the government has, you might expect a little more in some ways.
By the way, that was Guy's dog Flip in the background agreeing with Guy's view of the market. I think you have to ask what made this quartet of strategists suddenly bullish after a 25% move. And so, yes, you have to look at Friday's action by the Federal Reserve as something I think we'll talk about for years to come, the day a lot of debt in this country was socialized, or at least the prospects of it could be. And we talked about this on Friday. So wondering what suddenly gets people bullish other than price action is the question I think we're asking today. We have seen the plumbing improved by the Fed. So again, talking about how liquidity in both money markets, credit markets, commercial paper, things that actually need to move to have not only businesses function, but obviously to have investors be able to feel comfortable in markets. So yes, that's very good. Hard to see where equities get away from you here on the upside. Having said all that, there's very little in earnings season that will compel C-suite who are not going to give you any second quarter guidance, and probably not going to give you much in the way of 2020 guidance to say much of anything. So the question is, does this put you in the same place we were with the job market when people knew we were going to have 6.6 jobless claims 1 week and 5.5 the week before, and the market didn't even blink. So that may be good news for equities here. Ultimately, the question is, what's the multiple you want to pay on the S&P when in fact we're certainly going to be going through a very painful contraction period. But right now, the market hasn't necessarily been here. The last time we were here trading to the upside in a market was June of 2009, and it's hard to feel that the backdrop is as strong as it was there. So I think you have to be a little cautious when you get this response from the street.
Yeah, instead of seeing more, I guess we're going to see less. Tim, Dan, Nathan, you've talked about this in the past, but let's go back to these calls. Let's be honest. You can disagree with them, okay, but these are huge firms with tens or hundreds of thousands of clients. Their guys are on the phone calling up their wealthy clients saying, we think the bottom is in. If that puts money to work, it could become a self-fulfilling prophecy, could it not?
Well, yeah, of course it could be, Sully, but I think you have to go back to 2019, and you have to think about, that rally that we had in the Q4 where we broke out in the S&P 500 at 3,000, and over the next few months we went straight to the highs at 3,400-ish or so. And at the time, every strategist on the street was tripping over each other to raise their 2020 price target above the next bullish guy or gal. And the idea there was, don't fight the Fed. Why? Because the Fed started cutting interest rates for the first time time in 10 years in July, and then they started to do their repo operations, i.e. QE, and therefore we had this liquidity-induced rally late in the year. So here's the thing, every strategist was kind of hoping for the best and not preparing for anything other than the best. Here we are now. The stock market crashed, commodities crashed, the credit markets crashed, and we have a situation where we're off the lows. We're at the almost exact midpoint of that range in the S&P 500 from 3,400 in the upside down to 2,200 on March 23rd. And what these strategists don't want to do is be caught off sides from the next big secular shift. They're not going to get in a whole heck of a lot of trouble if we go back and retest the lows and at some point this year find a bottom. But if we go back to the highs anytime soon, they're going to be in a lot of trouble. So I would not be chasing tails around here. That's exactly what's going on, in my opinion. So to me, this is just what these infrastructures are there to do. They're there to keep people invested, keep them optimistic. I think this is a time where people should be preparing for the worst and, to use Guy's expression, hope for the best.
Well, Karen, Morgan Stanley lays it out very clearly. Pullbacks should be bought.
Right. I don't see this as a pullback, actually. I see this as a, giant leap up. I mean, we're down 20% from where we were. I think the market now, after the run we've had, is so much more expensive than it was at 3,400, given the uncertainty that we have. So this, I guess if they're saying a pullback from here, but this, to me, is not a pullback given what's happened in the world. So, I'm always long, and that's sort of my, cross to bear. But I'm not adding new things here because I think this market is really expensive.